Welcome to a special segment of ET Now. You are watching News Now, and now Reserve Bank of India has finally announced a dividend, a record dividend of 2.69 lakh crore to the government, while the expectation was there between rupees 2.5 lakh crore to 3 lakh crore. Finally, the announcement has come in at 2.69 lakh crore. What does it mean for the markets? What does it mean for bonds? We have Sajan Hajra to break up the scenario. Mr. Hajra, welcome to ET Now. I want to understand from you, first thing, what is your assessment of record transfer of 2.69 lakh crore now? Was it on expected lines?
Yeah, as you mentioned, the expectation was between 2.5 to 3. So it's sort of bang at the middle. While my sense was that it would be closer to 3 lakh crore. So in some sense, maybe 30,000 crore less. But nevertheless, as has been highlighted, that they have changed the norm for the reserve CRB. So in that sense, it's pretty good number.
To put into perspective, the contingent risk buffer will be maintained with 6%. Plus minus 1.5% of a balance sheet, which gives the range up to 7.5% on the upper side and 4.5% on the downside. What does it mean for markets, and why this change is made according to you, Mr. Hajra?
So first of all, what it means for the market, obviously this is about 15,000 crore more than what was budgeted. So from a fiscal standpoint, this is a good thing. Already we have the first month number for GST, which has reached a record high, almost 13% higher than the record high of April 2024. So on a net basis, India's fiscal situation is doing better than expected as of now. And therefore, we have seen the bond yields also have come down. And as bond yields come down, that actually has a positive impact on the equity market, because that reduces cost of fund as well as the discounting factor on future earnings. So therefore, this is both positive for equities as well as for the bond market.
Right. Apart from that, the range of monetary and fiscal stability buffer has also been widened to 3.5% to 6.5% of balance sheet. What is the impact you assess due to this step, Mr. Hajra?
This is more of a financial stability kind of a measure. We have seen over the last couple of years, there has been significant increase in geopolitical uncertainties. And we have also seen the increased hostility in our neighborhood. So therefore, this is more of a contingency measure. This is keeping us prepared for bad time. So this will actually reassure investors. While RBI board could perhaps transfer some 30,000 crore more, but rather than transferring it to the government by increasing the buffer, it actually has done a great job in terms of creating stability in the financial sector. So this is a positive for the economy. This is a positive for the market.
Right. We also have Lakshmi Iyer joining in the show. Welcome, Lakshmi. Welcome, Lakshmi. My first question to you will be, what is your assessment of this figure of 2.69 lakh crore? People are expecting 3 lakh crore and even more.
Yeah, it's always, ye dil mange more kind of a situation. The numbers, were ranging. The ranges were very, very wide, base being lower end of 2.5 lakh crores. To upper end of 3.5 lakh crore. So it's somewhere in the middle. So yes, if you look at a glass half empty, those who are expecting north of 3 lakhs are in for a little bit of disappointment. But look at the brighter side. Clearly, this is the highest ever number that we have seen in terms of surplus being transferred. So I'd say that it's definitely when too much of positive news is kind of baked into the price, the number might not look that great. But yeah, definitely from all the past years, the numbers definitely seem on the higher side.
If you look about the budgeted number of government which was given in the budget, this number is even higher than that because that 2.4 lakh crore, if I remember it correctly, also included the PSUs. So definitely it is going to give some kind of boost to government in terms of fiscal management, Lakshmi.
That is absolutely correct. Any form of surplus is an income, to the exchequer, and to that extent, it definitely goes a long way, in terms of signaling a positive message. May not be, as I said, from a market standpoint, it was already well discounted into the prices, so it's not going to be a mover or a shaker kind of a number, but definitely it goes augurs well from a deficit standpoint.
The movements now, because since the large number was already factored in, how do you think bond prices will move now?
So as I mentioned, the discounting of this news was pretty much in the price. Broadly, the markets had an assessment. In fact, right now, we have seen actually a marginal, actually flat to marginal movement in bond yields. It's largely going to be a function of how the US yields actually plan out, because the domestic factors, whether it's inflation or the current dividend transfer, all are very, very positive, I would say, boosters to keep the bond prices anchored. So I think the positive sentiment is going to continue, but no major reaction we are expecting on account of this move, because these numbers, as I said, are broadly in line with market expectation. So not really expecting any major movement on the yields, just because of this data.
Right. Lakshmi, before you joined, we were discussing CRB, which is now maintained at 6% plus minus 1.5%. I want to understand from you, there were many questions earlier on what grounds this kind of transfer is made. There is a committee which had recommended a formula, and that Reserve Bank of India is maintaining that the decision on any kind of surplus transfer is made on those front. Now with these changes, do you think that there will be any change in terms of the calculation, or this is more of a more flexibility kind of a scenario which is given to Reserve Bank? All right, I think we have a patchy line with Lakshmi. Mr. Hajra, as I was discussing with Lakshmi, I want to pose the same question to you. How do you see these changes? Is it more of a flexibility kind of a scenario, or do you think the rules of turf will change?
As you see in the context of inflation targeting, also you have a band. You have a 4% target with plus minus 2. So therefore, you get a broader mandate. So given in a particular situation, for example, when we faced COVID, during that time, there was a different level of uncertainty. If you look at the transfer by RBI during that year, was close to 30,000 crore, which was one of the lowest in recent years. At the same time, last year you saw 2.1 lakh crore. This year we are seeing 2.7 lakh crore. Obviously, it depends on the situation. So RBI will have the discretion. Say if it's a buoyant situation, if the geopolitical uncertainties are low, RBI might transfer less amount to this fund and transfer more money to the government. At the same time, if there is some elevated geopolitical risk, RBI will have the discretion to. So it's more of a discretion. So you have a broad range, 4.5 to 7.5, which is really a broad range. So it gives a lot of elbow room to RBI, and so in that sense, RBI can exercise caution, and RBI's objective of maintaining financial stability.
Yes, definitely. One last thing I want to understand from you before I let you go. Now this 2.69 lakh crore dividend announcement has been made. Once again, questions will be raised. What is the scenario of this kind of calculation? Even though there is a formula, even though the rules have been changed, how do you think this economic capital framework has panned out over the years, and do you think there is some merit in the revision of the same?
See, the fact of the matter is that you have a close to $700 billion of foreign exchange reserve, and with the current yield situation, you are making a significant amount of money from there. Similarly, if you have a significantly large book of government securities and you are getting some yield from that, at the same time, you are getting money from your liquidity adjustment facility when you are lending to banks. So obviously, keeping this money parked just with RBI does not make much sense in the sense that when it can be used, it can be used. At the same time, there is a trade-off here. Capitalization of RBI is important from a financial stability standpoint. So I think this CRB framework has done well in balancing the two competing goals. One, to give more support from RBI to the government in terms of greater transfer of surplus. At the same time, keeping RBI well capitalized so as to withstand any financial instability. So I think the CRB framework has acted pretty well, and it has given us certainty on the quantum of transfer, at least a range within which this transfer can be done. So I think this is a pretty good framework. And increasing the range from 5.5 to 6.5, which was earlier 5.5 to 6.5 to 4.5 to 7.5. Now RBI is getting additional latitude in maintaining this. So it gives further operational autonomy to RBI in deciding the quantum of transfer.
All right. Thank you so much, Mr. Hajra, for joining at this hour. Clearly, it is a record transfer by Reserve Bank of India of rupees 2.69 lakh crore, even topping the last year of 2.1 lakh crore, which was transferred in the last fiscal year.